We've got Gargi Pal, as promised, Gargi Pal Chaudhuri, head of iShares Investment Strategy Americas at BlackRock, now joining us. Gargi, great to have you with us here in our studios. Appreciate it. Thanks very much.
Wonderful to be here. Thank you for having me.
So, the big talking point from a US perspective is increasingly the question being asked by some of the veterans. Stanley Druckenmiller recently raised that question, whether the Fed's made a mistake with the 50 basis point cut, because the bond market is saying so, and rather loudly recently. What's your sense?
Look, I think the pace of policy that was in place prior to September, so having the Fed funds rate at being above 5%, that was put in place for an inflation regime of 5%. As inflation started moving lower, and obviously we're now very stably at much below the previous levels of 5% and sitting comfortably in the 3% range, we don't need to have such restrictive policies. The Fed perhaps should have gone 25 in July and 25 in September. They started with a 50. That's absolutely fine. This is not a regime of inflation that requires such high interest rates. I think they need to normalize policy. They'll keep doing so. They'll continue to move in, we think, another 25 or 50 basis points by the end of this year. And that will just be bringing level of rates from restrictive down to a more normalized level of rates, which make absolute sense.
There are 2 points here, Gargi. The neutral rate may be much higher. It may not be. That's one point many are making. And the second is data out of the US is still very strong. And as, again, I go back to what Druckenmiller said, I'm a big fan. And he said the Fed is kind of wedded to its guidance, not so much to the data. His point is they should get rid of the guidance. They made a mistake in 21, which I think we can all agree with the benefit of hindsight. Do you think, we're at the same juncture in an opposite sense now here?
Yeah, and I think, look, when we look back, should they have maybe started even earlier is what I think. It's not about, if the issue is going 25 versus 50, look, it doesn't matter. Rates are really, really restrictive. They're not the level of interest rates that need to be in place for a 3% inflation, perhaps even 2.5% inflation. And that is what the Fed is doing, normalizing. I think we need to make a very significant difference between normalizing policy and restrictive policy. And right now, we're in the process of normalization, and that might end up meaning a much higher neutral rate of somewhere around 3.5%. We're not there yet. The data, as you point out, continues to be so resilient. There is a clear story of US exceptionalism, but that doesn't mean, and in fact, more so, I think the Fed is enhancing the growth aspects, which I think are amazing at this point.
So what I hear, it seems it's party on. Because you're expecting the rate cut cycle to continue, irrespective of the data being as resilient as it is. So where does the money go now? And can the outcome of the US election, whichever way it goes, can it at all be a party pooper?
Absolutely. So a couple of questions there, and I'll take them each at a time. So earnings growth is strong. We're in the middle of earnings cycle, obviously, globally. And what we can see, especially again in the US, is earnings growth remain pretty robust. And so far, and obviously next week is a big week, we're excited about that. So far, the earnings guidance, anything that we can learn about corporate credit or anything that we're hearing about consumers, all are actually pointing to a very positive outcome. So that's good news, right? Secondly, you make a really important point about elections. That's certainly a risk event, but it is something that in 2 or 3 months we will not be talking about. The risk event will be over. The third point that I want to make is just around the cutting cycle. That is, we're in the middle of a cutting cycle that's going to continue. So the combination of a risk event passing, and of course around the elections, can we see some higher volatility? Absolutely. But then once it's done, it will be over. Better earnings growth, continued very strong earnings growth, as well as a cutting cycle that will continue, they bode very well for risk assets. And to your point around where we see money move, I think we're expecting to continue to see all of this. There's about $8 trillion globally of cash on the sidelines. Investors have been waiting for this opportunity to step into the markets. We expect them to continue to do that, both in fixed income as well as higher quality parts of equity markets.
All right. Gargi, good to have you in the studio. Our audience would like to know, what about the Indian markets? We have corrected close to around 8% from the recent peak, and China, which was not an event till maybe a month or so ago, has suddenly bounced back.
Absolutely.
$10 billion of selling from the FIs here in India. From an FI perspective, where does this stop? Do you think bulk of that reallocation has taken place? And where does India feature in the emerging market
Yeah, of course. And, when I was here in your show last time, I talked a little bit about how India continues to be an area of opportunity in global markets for investors. And I think that story remains very, very relevant now, despite the news that's come out of China. In fact, even more so. I think even more so investors are now going to really consider emerging markets, especially those investors that have historically sort of had an underweight allocation to EM equities or even EM debt for that matter, might want to get back to benchmark. So I think that bodes well for all emerging markets. In the short term, we absolutely have to keep our eyes on the reallocation that you're talking about. So there has been this move away from India and perhaps trying to get back to benchmark on China. Those are temporary things. I think when we're talking to investors, when we're talking to our clients, what we're talking about are the broader themes. Here's a country that has tremendous growth potential, that has decelerating inflation, that has a central bank that's about to, or we at least think that are going to start their cutting cycle by the end of this year. And on top of that, we do have a very stable and healthy banking system. Those are all really good for the medium-term investor.
But, Gargi, while we love hearing everything that you're saying about India, my question is if the home market is going to do as well as you're expecting it to, because you've painted a great blue sky scenario for the US market, then will EM funds even be drawing in that much money? And then we get into the debate of, who's cutting from where and adding to where. But will it continue to be a DM story?
Yeah, I think that the starting point is important. So when we look at how portfolios are positioned, many investors have, rightfully so, been very overweight to the DM part of their portfolio and perhaps not as overweight to EM. In the months and quarters ahead, to the extent that you see DM growth continuing to remain resilient, US growth continuing to be much above expectations, that paints a picture of global growth as well as, a very good opportunity for EM. So I think both can coexist. The biggest beta for EM growth is actually DM growth. Mm-hmm. So I think that is something that investors will take in mind.
US is a staggering 63% the global market cap, right? Mm-hmm. Can it go to higher or maybe a few percentage points? Yeah. We'll see. But who's winning in the elections?
Certainly.
We all kept hearing it's close. It's not so close now, is it? Or is it very close?
Honestly, as none of us have any edge in trying to say, who's
but markets
winning.
Are pricing
markets are, as of right now, looking at, or at least polls as of right now, are very, very close. And we have no edge in, trying to figure out who it's going to be. What I'm talking to my clients about is trying to think about what works in your portfolio regardless of the outcome.
Okay.
So, investing in parts of, and we talk about this as quality, earnings growers, looking at companies that have low debt but very strong earnings growth, looking at large cap value, continuing to focus on quality, continuing to focus on income. Those are things that will matter. Looking at infrastructure as a theme in your portfolios, that's going to remain no matter who wins in November.
Who's there. Gargi, it's lovely speaking with you here in our studios.
Absolutely.
And we hope we can do more of this. Thank you very much.
Of course. Thank you for having me.
For joining us here.